Okay, so let's talk about private market investing. For the longest time, right, this was a world that was completely walled off. But now it feels like those gates are crashing down for everybody. The big question is, are they really? I mean, you've probably seen this slogan everywhere. It's on fintech apps, it's all over crypto projects, and hey, the promise is amazing. It's this idea that regular people can finally get in on those big deals that were always just for the super rich. So, that's what we're going to do today. We're going to peel back that marketing layer, look past all those flashy slogans, and see what the data actually says. Is this the real deal, or is it just a very, very convincing illusion? And to guide us on this little investigation, we're going to lean on this fantastic research paper by Ben Bates. You can think of it as our X-ray machine. It's going to let us see right through the skin of these investment products and get a look at the bones underneath to see what's actually going on in there. Okay, so the paper really hones in on one specific thing that's exploded in popularity. It's called a business development company, or a BDC for short. And all that is, really, is a type of fund that lets regular investors get a piece of the action by investing in smaller private companies. And what this X-ray shows us? Well, it reveals a couple of hidden truths. And honestly, they're pretty uncomfortable, especially when you realize these are the products being sold to most people with that shiny democratization label slapped right on top. So what are these big, uncomfortable truths? Well, it boils down to two things. It seems that the price of admission for most of us comes with, first, this really dangerous illusion of safety, and second, something called a quality gap, which is just a nice way of saying the wealthy are still getting a way, way better deal. All right, let's tackle that first one, this illusion of safety. How exactly do they pull this off? Well, it's all about how they hide the risk. You see, the valuation methods they use, they basically just mask the real risk of the stuff inside the fund. So what you see on the surface looks calm and stable, but underneath, it's a completely different story. And just look at this chart. I mean, the gap is massive. On the one hand, you have the reported volatility. This is the smooth, pretty line they show investors. But then you have the actual risk of the assets in the fund, and it is so much higher. They're showing you a picture of a calm lake, but you're actually floating on a very choppy sea. So that begs a really important question, right? If the risk isn't showing up in the day-to-day price, where does it go? How does it eventually hit you, the investor? Well, it pops up when things go bad. It shows up in a crisis. Think about it. The market gets shaky, everyone gets nervous and wants their money back, and suddenly the fund is trapped. They have two terrible options. Either sell off their assets at fire sale prices, taking a huge loss, or, and this is what usually happens, they just slam the gates shut. They block you from getting your money out. And just like that, that super smooth ride comes to a sudden, jarring halt. Okay, so that's the hidden risk part. Now let's talk about that second uncomfortable truth, the quality gap. And in some ways, this one's even more concerning. What the research shows is pretty shocking. There's basically a two-tiered system. You've got one lane for the wealthy, accredited investors, people with a certain high income or net worth. They get offered what are called private BDCs. Then there's the other lane for basically everyone else, and they get pushed into these non-traded BDCs, usually by brokers. And here's the kicker. The cost of being in that second lane is huge. We're talking about a 2.7% underperformance per year. Every single year, the funds for regular people do that much worse than the funds for the wealthy. Over time, that difference is absolutely massive. It's the perfect example of how getting access is not at all the same thing as getting equal access. So, you gotta wonder, how does this whole machine work? Who's pulling the levers? To get that, we need to look under the hood at the actual business model that makes all of this possible. It's actually a pretty simple four-step playbook. Step 1, you take a bunch of risky, hard-to-value private assets and you bundle them up. Step 2, you only value them once in a while, which creates that artificially smooth performance chart. Step 3, you go out and market the whole thing as this super safe, stable, low-volatility investment. And step 4, you keep those withdrawal gates in your back pocket as your emergency escape hatch for when things inevitably get rocked. And here's where it gets really clever. You take that fund structure and you plug it into a slick, user-friendly fintech app. And what happens? You don't get rid of the gatekeepers. Nope, you just get a new set of digital gatekeepers. They look fresh and modern, but they're running the same old playbook, hiding risks and offering different tiers of quality. Okay, so it's one thing to point out all the problems and all the traps. That's the easy part. The harder and frankly more important question is, can we build something better?
Is there a way to actually deliver on that original promise of democratization?
And let's be clear, the answer isn't just to take these broken models and slap them onto a blockchain. That doesn't solve anything. It's like putting a faster engine in a car with no brakes. A real solution needs to be built differently from the ground up. It has to have a totally different philosophy.
So what would that look like? What are the building blocks? Well, it'd be based on a few key principles. First, radical clarity. That means you see the real risk, not some pretty smoothed out chart. Second, honest liquidity. You know the rules for getting your money out up front, no surprises. Third, no hidden tiers. One system, one set of rules, one deal for everybody. And finally, rewards tied to actual outcomes, making sure managers are incentivized to perform well for investors, not just to suck in as much money as possible.
And that's really the heart of it, isn't it? It's about a fundamental choice. Do you use technology to hide complexity and risk behind a slick interface, or do you use it to reveal complexity, to make things transparent, and to actually empower people to make their own informed decision?
Which brings us all the way back to where we started, back to that big, flashy phrase. So what's the big takeaway here? What should we really be thinking about? What should we be demanding the next time we hear someone promise to democratize private markets?
It really comes down to this choice. What do you want? Do you want a smoother line on a chart? Or do you want a structure that you can actually look into, that you can understand, and that you can choose with your eyes wide open? That's the real question. Because being given the tools and the transparency to make that choice for yourself, well, that's what real democracy should be all about.